Yeah, so I think that there's a combination of things going on right now. I think that there has been, just this big wave of profit taking us, not just in the equity markets, but it seems like whatever people bought in the last couple of months, they're taking profits on. So it's stocks, it's the short dollar position, it's profit taking on gold, it's profit taking not just on stocks in general, but especially those that really led, like the FANGs. And so I do think this is a correction, and rather than a new bear market or something. But at the same time, it doesn't mean it can't continue a bit longer. I think that it's hard to imagine the U.S. providing more fiscal or monetary stimulus before the election. And so, we look after a big move. We look at how far back can it fall, and we have all these different retracement objectives. And given how strong of a run-up there was, we could still fall. Say the NASDAQ were to fall by 20%, which many people think is a bear market. That would just bring us back to the end of June levels. Yeah, so I think you're right. We've got the month end and quarter end next week, and right after that, we get the U.S. jobs data. And what's interesting with the U.S. employment data is The Economist says almost every week, you can do these surveys, and you can see how expectations have been gradually declining. And so so now, like when I was looking at the surveys about a week ago, people were talking about 900,000 increase in non-farm payrolls. Now they're talking about 865,000. And I think that still might be exaggerating because of the economists have generally over-expected. Their forecasts were stronger than was really the case for some key economic data, including industrial output and retail sales for August. So I still suspect there might be a little bit of downside, and it could be important for the market reaction. I'm not so sure it's important for policy. The Federal Reserve seems to have suggested that even though it might not be for several years, 3 years before they reach their targets, they haven't really announced new plans or new tools. And the main obstacle to fiscal stimulus in the U.S. is not the economic need, but the political paralysis. And so I think those things are going to be on hold, like you say, through the election, maybe even into next year. Just yesterday, we saw a near record amount of inflows into the ETF that tracks we call them the QQQ, the NASDAQ 100. And a record amount of interest, a record amount of cash flow, or a very high level if it wasn't a record. And I think what it shows is people are still looking to do exactly what you say. And that is, you have some of your favorite things, like whether it's Apple or Amazon or whatever it is. And you've been patient, and now you've seen like a 20% pullback in some of these. And so it does look like people are trying to buy. I think that it's hard to know on these kinds of things, even like professionals who spend their lives, their careers watching these markets like I have. It's hard to know when to get in on something like this. So two things I think should guide us. One is buy things of value. Do your homework, figure out what you think is value, buy things when they are below value. So it doesn't require like a greater fool theory to be able to make money. It just requires for things to go to fair value. And the other thing to remember, I think, is that sometimes we had this in the 1920s. We had a wit who said that it's sometimes better to focus on the return of your money than the return on your money. And that is, think about prudent investment strategies, capital preservation. There's been a huge rally in U.S. stocks from those late March lows. We've gone to new record highs, and so without much of a pullback, especially not a sustained pullback. And so I think these are really treacherous waters. And so, for example, if we would go down another 10% in the stock market, it really wouldn't change things from a macro point of view, but they could very much hurt us as investors. So it's always prudent to buy things of value. Keep in mind you want to make sure that the capital preservation. The thing that what this really means is that when we as investors, we should be guided by some principles, and one of them is buy things of value. if we're trying to be investors and not speculators. Secondly is just to remember that we've had such a big ride already up, and it's about capital preservation. It's not so much how much money you can make, but how much money you can keep. And it really, I think, requires a certain prudent type of attitude. We're trying to keep that balance between fear of losing and greed of getting more. And I think it's like in these kind of like long markets, these dramatic moves, that pendulum swings off of balance, and we owe it to ourselves and all this hard work we do for our savings to be prudent about it, I think, and keep those emotions in check.